Good morning and welcome to BloombergQuint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines. The government will set up an alternate investment fund worth 25,000 crores to provide last-mile funding to stalled affordable and mid-income housing projects. A one-time gain ensured Tata Steel remained profitable in the second quarter. Other operational parameters, though, were at multi-quarter lows. Moody's has placed Yes Bank's ratings under review for a downgrade, citing the lender's weak capital position and exposure to stressed assets. Indiabulls Housing Finance will raise up to 10,000 crore rupees through non-convertible debentures. The lender will also issue warrants through qualified institutional placements worth up to $1 billion. And four Nifty companies, BPCL, Sun Pharma, UPL and Power Grid, will be reporting their second quarter numbers today. Busy day for earnings yet again today, and on a day when we are about 100 points or less than 100 points shy from the all-time highs for the Nifty. But first, take a look at the global markets. Did precious little, so don't have too much to say there. The to and fro between the location of the trade meeting between Xi Jinping and Donald Trump continues. Until then, the markets were quiet. They're trading at near all-time highs, so no reason for them to keep on going up every single day, but the US markets were quiet. Asia today, this morning, also showing a bit of a quiet trade. But mind you, if you thought that it was the US markets which were setting the stage on fire and the other markets have been relatively quiet, well, take a look at this chart on the network, the Bloomberg network, and it shows that while the US stocks may be hot, Chinese stocks are hotter because the Chinese indices and the Chinese stocks have given much better returns. They've outperformed the S&P 500 and by a margin, I must say. So, and throughout, by the way, it's not just in the last 12 months or the last 18 odd months period or last 12 months odd period. By and large, you will see the Chinese equities outperforming the US equities by a margin. So US is hot, yes, but Chinese equities are hotter. Indian equities are hot too. The question is, can they last? It's futile to try and preempt what will happen. The last 2 days have been days of consolidation, and there have been surprise breakouts, as was the case yesterday. In today's session, the SGX Nifty indicates a start which is flattish. But you never know, if we have the Bank Nifty performing the way it did yesterday, we might have some more upsides to the Nifty as well, taking us closer to the all-time highs for the Nifty too, and the Nifty Bank as well. So those are important parameters to watch. Also important to watch what are the results that are coming out today. A clutch of names from amongst the index. BPCL, Sun Pharma and Power Grid are the three Nifty names, and there's a UPL as well, of course, but amongst the more important ones, BPCL, Sun Pharma and Power Grid coming out with numbers. UPL, steady state numbers anticipated. Let's wait and watch what happens there. Other key results include HPCL, important one, IGL, in line with what the gas companies are doing, very good, and DLF, after succumbing to 145, 150 odd levels, has risen very well in the last few weeks. Let's wait and watch if there is more in store. Whirlpool, United Breweries, Trent, Amber Enterprises is an important one. If you look at Voltas's numbers and how the AC division is done, it'll be interesting to see what Amber does, because it does that back end for air conditioning works. And Ipca Labs from 400, 450 back to 1,000 levels. So a clutch of these names, very well traded names, are coming out with numbers. So I'll watch out for all of these in the session today. But a lot of stocks that will react this morning as well, in all likelihood. Firstly, Tata Steel, the one-off gains aided profitability, but the EBITDA was at 11 quarter lows, and they're going to recalibrate the 1 billion deleveraging guidance for FY20 lower. We had done a story around this that maybe this was necessary, and Nikki will talk more about this. But watch out for Tata Steel. Brokerages have largely remained sanguine. Jefferies, I think, has come out with not a scathing note, but their note is a lot more bearish than the rest. They believe consensus will catch up. Let's wait and watch if Tata Steel reacts negatively in the session today or no. Very strong quarter for companies like Voltas, V-Guard, as well as Fortis. Now, for Voltas, the AC business reported very strong growth despite the non-seasonal quarter. For Fortis, it was a strong operational performance for V-Guard, that is a strong operational performance despite a muted top line. And Fortis did very well too. They reported a profit versus a loss on account of exceptional gains and lower finance costs. The SRL Diagnostics business saw strong EBITDA margins as well. Let's wait and watch if this one reacts in the session today. So that's an important one to monitor. Also, watch out for Mass Financial, and Manappuram Finance, the three NBFC names that came out with numbers, all three had some positive to take home from. Let's see if there are some positive reactions that come in for each of these. Sorry, I forgot BSE, Bombay Stock Exchange, a very weak quarter. They reported an EBITDA loss versus again the last year. So that one too. It's a stock that's anyways trading much lower, but let's wait and watch if there is more in store today. And last but not the least, Pratap Snacks, from an earnings perspective, do watch out for this one. The gross margins improved on raw material cost. The key positives were the better operating cycle and lower inventories. Might react positively to numbers. And then I would watch out for two names or two sets of names. First, the real estate names, because of that 25,000 crore fund for real estate. So watch out for Nifty Realty and some of the individual real estate names, very important. And lastly, watch out for the consumer stocks. We've seen volume growth surprises from Dabur. GCPL, yesterday the numbers didn't look all that bad, and the commentary from Godrej Consumer, particularly on the conference call, was very impressive. CLSS come out with a double upgrade on GCPL as well. They've hiked the target prices. I dare say these consumer-facing names, Godrej Consumer, Dabur, etc., could well be the stocks that you should monitor in the session today. Anyways, let's tell you what's lined up on First Word today. We start off with arguably the most important piece of news last evening. Nikunj Ohri takes us through the details of the government's proposed 25,000 crore realty fund and what's changed from when it was first proposed and now. I put the recent rally witnessed in the listed asset management company stocks in context. Nikki then joins us to take us through Tata Steel's numbers to tell us why the company is still in so much pain. And two state-run fuel retailers, BPCL and HPCL, come out with their numbers today. Somit tells us what could be in store. In what comes as some relief for home buyers waiting on stalled housing projects, the cabinet has approved a special fund that looks to provide last-mile funding for such projects. Nikunj Ohri has more details in this report.
The government has announced a 25,000 crore rupees relief package for the real estate sector, which is expected to complete about 1,600 stalled housing projects and about 4.58 lakh housing units or homes. The Union Cabinet has approved setting up of a special dedicated fund that would be funding stalled middle income and affordable housing projects. The announcement for a fund was first made in September when the finance minister had announced that the government would put in about 10,000 crore rupees in a dedicated fund that would help in completion of stalled middle income and affordable housing projects. The eligibility criteria of the fund was previously that only non-NCLT and non-NPA projects could avail the benefit of this fund. The government has now relaxed this criteria and has said that even a project which has been classified as an NPA and a project which is under NCLT can avail the benefit of this fund. The only criteria is that it need not have a negative net worth. The initial corpus of the fund would be 25,000 crore rupees and the remaining 15,000 crore rupees would be put in by State Bank of India and Life Insurance Corporation of India. The government is also hopeful that other sovereign funds and pension funds would also put in more money and take the corpus size to over 25,000 crore rupees. The fund would be managed by SBI Capital Ventures and is expected to complete about 1,600 housing projects.
Well, this is important. This has got some changes compared to the one announced earlier in terms of the amount as well. I dare say a lot of the stress in the books of real estate companies are not necessarily only with the mid-income and low-cost housing projects, but also with the premium housing. And I think liquidity situations getting eased up is largely the bigger thing that is the need of the hour. I was speaking to a couple of real estate developers in the night. Last night, and they thought that while this is all commendable, somehow the current in pricing or sales, etc., is not coming through, and maybe just maybe some easing of liquidity, which might happen at whichever time, and you don't quite know what effort of the government might lead to that, but that's the call that is coming in from large real estate companies. Now let's wait and watch. There might be a flash in the pan reaction for a clutch of names. Not all the listed players, by the way, have exposure to the low-cost housing projects, and the ones that do are anyways doing well. So you don't quite know what's the fundamental rally that will come into some of the real estate names today. But let's wait and watch. There might be, as I said, some sentimental uptick that we might see in Nifty Realty by and large. There has been sentimental and otherwise an earnings-led uptick in asset management companies. They've been gaining for the last 3 months at least, if not more, as Indian equity emerges as one of the favored investment options right now. Now, just trying to put into context, which of the stocks have moved, what are the current valuations, and what could be the outlook ahead. And AMC and AMC linked stocks, by the way. So there are two pure play listed asset managers, which is HDFC AMC and Reliance Nippon Asset Management. And then there is, of course, Motilal Oswal and IIFL Wealth, a couple of others which have wealth management and asset management embedded in that. IIFL Wealth is a pure play wealth management. Motilal Oswal, the listed stock, has a large component in the SOTP valuation of the asset management business. And all of these have shown some gains in the recent past. Now, why this could be happening? One, I mean, the steady state reasons are well known. The physical assets aren't giving the kind of returns. Real estate, a case in point. Gold has, but real estate, which is a large investment avenue, hasn't quite given the returns. So people are obviously moving towards some of those liquid assets like the ones that are given by the AMCs. There's a higher pace of growth in equity AUM for some of these AMCs, and which is actually working for them as well. And there is limited need for fresh capital for having some growth, and operational efficiencies are improving, which will lead to strong earnings growth over a 5-year period for most of the asset managers. Other than that, I think what is working out for the specific AMCs, and when we look at the listed AMCs, largely they are the larger ones, and the larger AMCs are actually seeing a remarkable shift. The kind of AUM growth that HDFC, Reliance Nippon Asset, and SBI and others are seeing, it's not coming into the other ones. So therefore, there is a much bigger operating leverage and higher free cash flows and payouts of the business with limited credit risk. There is no credit risk. Remember, we're speaking about how the non-lending businesses are finding favor. So no credit risk, and therefore higher free cash flow generation, and maybe possibilities of higher reimbursements to shareholders. So all of that is keeping these stocks very, very excited. And despite what is optically higher valuations, these stocks tend to move up. Now, over the last 2 years, we've had a number of interactions with people who have spoken about why they like the asset management business. I'm using a couple of those out here to just emphasize the point that people have made. So Prateek Agarwal of ASK Investment Managers back in August 2018 made this very interesting point about how there is a natural growth in the assets under management for most of these asset managers, right? Debt and equity compound 7%, 10%, 12%. So combined blended yield about 10% AUM growth, and AMCs earn their revenues as a percentage of the AUM. So there is a natural growth in the assets under management, and new flows on top of that leads one to believe that the business can grow at 15-20% for a really long time, and profits can probably grow at a much faster pace. Nilesh Shah in October 2019 on the Dhanteras Day mentioned as well how the space is usually underpenetrated, and there are businesses that have a runaway growth for maybe 10, 20, 30 years, and that how you're better off with the top 3 players or top 5 players. So therefore, HDFC and RNAM are both getting the kind of valuations that they are getting. Now, just very quickly, putting the individual names into perspective, HDFC AMC, and you frankly know that it's living up to its billing because of the higher valuations and the higher price growth that it has had. But why is it doing so? Well, it's the most profitable AMC in the industry since 2011, measured as a measure of PAT to AUM. And the strength of the HDFC brand name, Prashant Jain has been the CIO for the last 16 years, and therefore that legacy of Prashant Jain, HDFC AMC, the same management team, all of that helps. And just look at the kind of gain in the market share of AUM that HDFC AMC has demonstrated. This is just quite phenomenal for a large player going out and gaining even more market share on that base, which tells you volumes about something that they are doing. A statistic out here, HDFC AMC received SIP flows, SIP flows of 12.8 billion per month as of September 2019, and 80% of the SIP book has a tenure of more than 5 years, which speaks volumes about the stickiness of the business. RNAM, and I think the change of promoter has led to the change of sentiment in Reliance Nippon Asset Management, frankly. I mean, if you just look at what's done in the last 3 odd months, there has been a huge surge in the stock price of Reliance Nippon Asset Management. So Nippon bought out Reliance Capital stake, and while there is a sharp drop in market share for Reliance Nippon Asset Management because there is and it's facing some distribution disadvantages versus the banca peers, the likes of SBI, HDFC or ICICI Bank, it is focused on developing a strong IFA network as well, which is helping it. The IFA AUM for RNAM increased from 35,000 crores to 58,000 crores in Q2. the last 3 months have been fabulous for Reliance Nippon Asset Management, to be honest. And then, I mean, just look at the kind of detailing that is going into the kind of growth. New businesses are getting 41% uptake in digital growth, etc. So RM in that front is doing well too. Motilal Oswal, one would presume that challenges remain despite the stock price uptake that we've seen. The Q2 results have shown improvement in broking and fund-based incomes, but the AMC business is lagging. The rise in AUM is the key driver, and whether that happens or not remains to be seen. The market share in SIPs business also has gone down, but the market believes that maybe that could change because the performance in the last 6 months has been pretty strong for Motilal Oswal Asset Management. So let's wait and watch if that turns around. Quick last look at the valuations for these players, and I've only compared HDFC, AMC and RNM because they are the pure play players. As per the note by Centrum Broking, FY20 expected and FY21 expected valuation numbers out here. This is the P. So 35 times FY20 and 41 times for HDFC. So do watch out for these. And the ROEs numbers for both HDFC and RNAM. FY20 expected ROE of 39%. FY21 the ROE might go up to 40%. And for RNAM it might go up to 24%. So strong 24%, but lower compared to HDFC. And which is why the kind of growth that we're seeing in the stock price of HDFC AMC. So do watch out for these as well. However, as we've been saying, it is important to watch out for what happens to real estate. And before we move on to the next piece on First World, it's important to get in Mr. Dinesh Kumar Khara. He's Managing Director of State Bank of India, joins us right now on the show. Mr. Khara, good having you. Thanks so much for joining in. What do you make of this new avatar of this real estate rescue fund, as I like to call it? What meaningful change do you think this can bring about?
Well, I think this is a very good move from Honorable Finance Minister to ease out the stress which is seen in the real estate sector, because there are many projects which are getting stuck, which got stuck actually, and the money was locked into such projects. So it has led to a situation where, you know, the cycling of the money stopped, and then of course the assets turned NPA, etc. So I think this kind of a move will provide the last mile funding, and it should be a priority funding also. And it will ease out the stress which is there in this sector, and perhaps it will also ease out the stress in the NBFC sector as a result of that.
Mr. Khara, all efforts are good efforts for a sector which is beleaguered, if I may use that term. My question, sir, is this, that this will probably do wonders for some of these low-income or affordable housing projects. A lot of stress exists in the segment which is not a part of this as well, and builders out there are crying for some bit of relief, some bit of liquidity. Does this in any way do that, because banks will be able to recover some of the monies, or NBFCs will be able to recover some of the monies from the mid-income projects as well, and therefore the ability to lend to some of the other spaces in real estate might open up?
As per the scheme of things which have been announced, the unit price is expected in the Mumbai metro region would be around less than 2 crores, and in the other metro regions it would be less than 1 crore. And also it is meant for middle income and low income kind of houses. So that is something which has been indicated in the scheme of things. So I think as of now, at least, you know, this kind of a sector will start seeing some kind of a movement. Otherwise, everything was stuck. So at least something will start moving, and I'm sure they will have some kind of a ripple effect on the remaining such projects also, which may be high income as well.
Anything else, Mr. Khara, that could have been done or could come as an amendment? Because I think these measures for the real estate space have been ongoing. Somehow they haven't quite led to the desired effect. No fault of anybody. I'm just saying they have not led to the desired effect. Do you think additional measures could have been done or will be announced in due course of time, or can be announced in order to expedite the easing of pain?
Unable to visualize any such thing as of now, but we'll wait and watch. Let's see how things happen.
What does this do for SBI, Mr. Khara? Just one, because I believe these lending to these projects would be a very small part. I believe last time that we spoke to you, you mentioned that your exposure to the LAP book would be negligible or nil per se.
LAP, we do have some exposure, but it is actually relating to the builder's loan, which will have an impact. So on that, I have not really taken stock of the situation as of now. But yes, of course, we'll wait and watch. But as I mentioned, that more than anything else, it will probably ease out the position with the NBFC sector. And because NBFC sector was was quite upbeat when it was the builder's loan more than the banking sector. So I think I expect that NBFC sector would have some comfortable position now.
One certainly hopes that happens. Thanks, Mr. Khara. Thanks for taking the time out and speaking to us. Well, that's the view from State Bank of India. I still think that, I mean, based on the conversations that I've had with people as well, that a lot of the stress names in the larger pocket will probably be still left out of this. This is a commendable move, not taking away. I think a few industry bodies, a few industry people will say that maybe some more needs to be done. On the website, by the way, if you read the article that BloombergQuint has posted as well, the CREDAI president has said that there are some things that needed to be done, or it doesn't address the issues of home buyers as well as developers. This is Nayan Shah, the president of the CREDAI MCHI body, who has put out this as well. So do log on to our website and try and read more about this. Everybody's hopeful. Let's see if turnaround comes about or not. Okay, on to the next two pieces. Tata Steel reported a profit growth in the September quarter, contrary to expectations. But that was owing to a one-time tax gain. If you look at the operational performance, EBITDA fell to a 11-quarter low. Nikki Mirchandani, who was telling us about what to expect from Tata Steel, now joins in with the fine print. Nikki, good morning. What stood out?
Actually, the numbers were pretty bad, and I can't really take heart out of the commentary also. Even if the brokerages make some kind of relief, do see some relief coming out of that, but it's mixed on that level. Let's address the basic numbers first, because clearly the disappointment has kept in from the operational performance of the company. It's essentially the higher inventory build-up, the weaker demand, and the liquidity pressures combined together weighing on the earnings of the company. Revenue, we've seen a 15.4% downtick. Net profitability, on account of that deferred tax gain, they have risen by 15%. The number has come to around 4,144 crore. As compared to an estimate of a figure sub 500 crore. So clearly there is a beat out there, but that's on account of that exceptional item there. Reported EBITDA has come down to 56% to a number of 3,800 crore, which is the lower EBITDA that we have in at least 11 quarters now. Margins, for that matter, they have shrunk. If you look at the EBITDA breakup of the company, just to understand where the disappointment essentially is coming from, while all the divisions on YOY basis, they have clocked in and decline out there. But then standalone basis and for Bhushan Steel, the numbers have been pretty much in line. In fact, for European business too, we were estimating a EBITDA level loss, and there is a profit out there. It's clearly the other businesses out there which have led to the higher expenses and weighed on the operational performance of the company. But then essential point here is the debt performance of the company. Now remember, Tata Steel is mostly equated with the kind of leveraging position that the company has on its balance sheet right now. Gross debt, that has moved up by 10% from March to September 2019. And what essentially the company has said that it's going to be recalibrating that $1 billion mark plan. I'm going to buy a moment here, Neeraj, and go on to say that back in June 2019, when we did an annual report analysis, we put out and said that the annual report at that point of time on its debt reduction plan was clearly not ambitious, focused, and the targets look very ambitious at that point of time. We did an interview asking them how they're going to go about with it. They sounded confident, they gave us way, but then they did not give us the figure. So which made us feel that this mark is going to be an ambitious one. And come September, we see the recalibration happen. We saw the capex plan. They said that they already have revised that down from 11,000 odd crore to 8,300 crore. But they said there is going to be a further potential for the capex to come down in order to recalibrate that debt requirements. In terms of commentary now, they said that they're going to be looking to increase the export volumes. Now, export realization or export HRC prices is around 3,000 to 5,000 rupees per ton lower as compared to domestic prices. So clearly, if they're increasing that share, that will be on the operational performance of the company. Also, if you look at what they said for auto industry, they said they're seeing some signs of recovery. Recovery will fully come in the coming months. That's the expectation. But at this point of time, the state still remains fragile. The contracts are lower. H2 contracts are lower than H1. So net-net, they're not seeing essentially good demand outlook also. Domestically, they said that they've hiked the prices, but whether or not the market will be observing those prices, that again remains to be seen. So net-net, if you put all the things in perspective, you would realize that the commentary also is not that encouraging. They have given the flagged issues on their recalibration of debt. Capex will be compromised. I don't know what good thing can you see from this number, even if you go on to argue that spreads are going to be now essentially higher because costs are coming down. But it's going to be taking a long time.
Are brokerages as negative?
brokerages have maintained their rating, they have maintained their target price, but then if you look at the commentary, it's pretty much their writing is on the wall.
Okay, let's wait and watch how Tata Steel reacts to it. Nikki, thanks so much for putting that into perspective. And do try and log on to our website and try and read not just about Tata Steel's current quarter, but also something that we wrote in the past about why is it that the targets for debt reduction look a bit ambitious and maybe they need to recalibrate, which they have done at the end of this quarter. The last piece on First Word is about a couple of very important earnings that will come out. Both BPCL and HPCL will report the second quarter numbers today. Strong refining and marketing margins may partially offset the inventory losses and tepid demand. Samit Sarkar is standing by with what the markets are pricing in for each of them. Samit.
Well, as you mentioned, it is expected to be a strong quarter for both the companies, that is BPCL and HPCL, because of a stronger refining and marketing environment. However, some of these positives will be offset by an inventory loss and the tepid consumption growth seen in the second quarter of financial year 2020. I'll start off with the headline numbers for BPCL. The revenues are expected to be down by nearly 5%. Net profit and EBITDA is expected to be higher by nearly 55% and 44%. The EBITDA margins are expected to come in higher at 4.3%. Now, for HPCL, similarly, revenues are expected to be down by nearly 3%. EBITDA is expected to be higher by 66%. EBITDA margins are expected to come in higher at 4%, while the net profit is expected to double to close to 1,610 crore rupees. Now, the gross refining margin, that is the key number for both BPCL and HPCL, that is also expected to come in higher for BPCL at around $5.6 per barrel and for HPCL at $5.2 per barrel. Now, this is because the benchmark, that is the Singapore gross refining margin, that averaged higher at around $6.5 per barrel in the second quarter of financial year 2020. Now, on the marketing side, if you see the gross marketing margin earned by both BPCL and HPCL on sale of every liter of petrol and diesel, that averaged higher, because of which the marketing segment will be aided in this quarter. Now, as Brent crude averaged lower at around $62.12 per barrel, both the oil marketing companies are expected to report an inventory loss in this quarter. Now, on the operation side, if you see BPCL's crude throughput is expected to be higher by 7%, but that is because in the first quarter there was a planned shutdown. Similarly, for HPCL, the crude throughput is expected to be higher by nearly 19%. On the marketing side, the sales are expected to be down by 7% for BPCL, and for HPCL, the sales are expected to be down by nearly 8% compared to last quarter. Now, key things to watch out for from both the earnings: firstly, the debt levels of both the companies, and along with this, the pending subsidy dues from the government. Along with that, their outlook on refining and marketing margins, Kochi refining margins, and the status of Kochi petrochemical project specifically for BPCL, and the capital expenditure plans for FY20 for HPCL would be important to watch out for from this quarter earnings.
Okay, we'll watch out for all of these. Thanks a lot for that, Samit. Appreciate that, and we'll of course keep you on top of all these earnings as and when they trickle down or trickle out. That's all that we have on First Word today. Lots more lined up on Indian Open too. We discussed the benefits from the government's Housing Rescue Fund with OP Gandhi of Ajmera Realty and Anuj Puri of Anarok Property Consultants. Suhas Harinarayan of JM Financial Institutional Securities will be joining us on the sidelines of their investor conference in Mumbai. Discuss Indiabulls Housing Finance's fundraising plans with Deputy Managing Director Ashwini Huda, and second quarter earnings with Umang Vora of Cipla. But after this break, a full tilt towards the day's trade.